What if I told you there are ETFs paying 15 to 33% yields that don't slowly kill your portfolio like most high-yield investments? Here's the brutal truth that most financial advisors won't tell you. The majority of high-yield ETFs are basically financial quicksand. They promise you massive dividends while secretly destroying your principal. Most investors avoid high-yield ETFs because they've been burned by decay, watching their $10,000 investment turn into $5,000 while collecting those generous dividends along the way. But today, I'm revealing 5 ETFs that completely break this rule. These aren't your typical yield traps. They pay massive dividends and actually grow your principal over time. I personally own 4 of these 5 ETFs, and I'll show you my exact positions and why I'm betting my own money on these strategies. If you're tired of choosing between growth and income, this video is going to change everything for you. If you find this helpful, don't forget to hit that like button and subscribe for more smart investing insights. Let me tell you about my friend Mike. Last year, he was so excited about his genius investment strategy. He put $15,000 into YMAX, that popular covered call ETF everyone was raving about. Sure, he was collecting nice monthly dividends, but when we looked at his account 9 months later, his initial $15,000 had shrunk to barely $7,500. Classic yield trap. He was essentially paying himself back with his own money while watching his principal evaporate. That disaster got me thinking. There has to be a better way, right? The holy grail of investing. High yield without the decay. So I spent months analyzing over 200 different ETFs, digging through performance data, distribution histories, and underlying strategies. What I discovered completely changed my approach to income investing. After extensive research, I found these 5 remarkable ETFs that actually deliver on the promise of high income without destroying your wealth. By the end of this video, you'll know exactly which ETFs to buy, how much income they'll generate for you, and most importantly, why they won't slowly drain your portfolio like so many others. Let's dive into the first one. ETF number 1, QQQI. The first ETF has been my secret weapon for generating steady monthly income, and its ticker symbol QQQI, the NEO's NASDAQ 100 High Income ETF. This fund has completely changed my perspective on what's possible with high-yield investing. We're talking about a 15.35% distribution rate that translates to roughly $0.60 per share every single month. And here's the kicker. It's showing a 27% total return since inception. I'm going to be completely transparent with you here. I've been buying QQI aggressively over the past several months, and my personal goal is to accumulate 2,000 shares of this ETF. Why? Because the math is absolutely compelling. The strategy is beautifully simple, yet sophisticated. They take the NASDAQ 100, those top 100 non-financial companies, and generate additional income through a systematic covered call strategy. This isn't some risky gamble. It's a data-driven approach to extracting premium from the market's volatility. Let me break down what this means for your wallet. For every $10,000 you invest in QQQI, you're looking at approximately $1,535 in annual dividend income, paid monthly. That's real money hitting your account every single month while your principal continues to grow. The beauty of this ETF is its consistency. It's been paying distributions every month since inception without fail, and unlike those decay-prone alternatives, your investment value has actually increased over time. ETF number 2. BTCI Now. The second ETF might surprise you, especially if you're not a crypto enthusiast. It's BTCI, the NEO's Bitcoin High Income ETF, and it's paying over 30% yield with nearly 60% total returns. Before you roll your eyes and say, "I don't do crypto," hear me out on this one because the numbers are absolutely staggering. I'll admit, I wasn't initially a Bitcoin believer when it came to income generation. But when I saw BTCI consistently paying average probably somewhere around $1.40 per share per month, I had to take notice. I've actually been auto-buying this ETF weekly in one of my smaller portfolios, and honestly, my stack is growing faster than I expected. The high implied volatility of Bitcoin creates massive premiums when writing call options, which translates directly into those hefty monthly distributions. Here's what makes BTCI special. They're writing call options on Bitcoin futures, essentially collecting premium from Bitcoin's notorious volatility. Since Bitcoin moves so dramatically, the options premiums are substantial, which allows them to maintain that 30+% distribution rate. Even if you're skeptical about Bitcoin as a long-term store of value, there's a compelling argument for including something like BTCI in your income-focused portfolio. The volatility that scares most investors away is exactly what generates those massive monthly payouts. The distributions have been incredibly consistent, ranging from $1.25 to $1.51 per share monthly. That kind of income generation doesn't require a massive position to make a meaningful impact on your monthly cash flow. With a 30% yield, even a modest investment creates substantial income streams. ETF number 3, Meiji. The third ETF takes income generation to an entirely different level, and it's Meiji, the Roundhill Magnificent 7 Covered Call ETF. This fund offers something truly unique: weekly distributions. Imagine getting paid every Friday instead of waiting a full month. It's like turning your investment portfolio into a weekly paycheck system. Meiji focuses on the Magnificent 7: Apple, Microsoft, Google, Amazon, Tesla, Meta, and Nvidia. These are the companies driving the entire stock market, and Meiji leverages their volatility to generate a mind-blowing 34% annual yield. Since inception, this ETF has delivered a 13% total return, proving that you don't have to sacrifice growth for income. The weekly distributions have been remarkably consistent, typically ranging from 27 cents to 47 cents per share each week. Let me put this into perspective for you. Those weekly distributions average out to roughly $1.15 per share per month, which means your money is working harder and more frequently than traditional monthly dividend stocks. The beauty of weekly distributions is that you get fresh capital flowing into your account more often, giving you more opportunities to reinvest or use that income for other investments throughout the month. The strategy here is sophisticated but straightforward. Meiji holds the Magnificent 7 stocks and systematically writes covered calls against them. Since these tech giants have high implied volatility, especially around earnings and major announcements, the call premiums are substantial. This generates that impressive 34% yield while still allowing you to participate in the upside of these dominant companies. ETF number 4, BITY. If BTCI feels too aggressive for your risk tolerance, let me introduce you to BT, the Amplify Bitcoin Strategy ETF. This fund offers a more balanced approach to Bitcoin income generation, targeting a 24% annual yield while still capturing Bitcoin's upside potential. It's essentially the middle ground between traditional income investing and the wild world of crypto. BITY has generated a solid 15% total return since inception, proving that their strategy works in various market conditions. What makes this ETF appealing is its focus on growth and income simultaneously. They're not just collecting premiums, they're designed to capture Bitcoin price appreciation while generating that substantial 24% yield. It's like having your cake and eating it too. The beauty of BITY lies in its dual mandate. While pure Bitcoin investments can be extremely volatile and traditional income investments often lack growth potential, BITY bridges that gap. You get meaningful exposure to Bitcoin's potential upside while collecting substantial quarterly distributions. For investors who want crypto exposure but prefer a more measured approach, BITY offers an elegant solution. This ETF could be the perfect crypto allocation for income-focused investors who want to participate in the digital asset revolution without taking on excessive risk. The 24% yield is nothing to sneeze at, especially when combined with the potential for capital appreciation as Bitcoin continues to mature as an asset class. ETF number 5, BAG. For the final ETF, I'm saving the most aggressive for last. BAG, the Amplify Bitcoin Max Income Covered Call ETF with a focus on weekly options. This fund is paying a staggering 32% annual yield. And here's what makes it truly unique. They're writing weekly call options instead of monthly ones, which allows them to collect premiums 4 times more frequently. BAG has delivered a 15% total return since inception, while maintaining that incredible 32% distribution rate. The innovation here is in the frequency of their option strategy. By writing weekly calls, they're essentially harvesting premiums every single week, rather than waiting a full month. This higher frequency approach translates directly into higher yields for investors. The fund seeks to capture 5% price appreciation each week while collecting substantial option premiums. It's an aggressive strategy that requires more active management, but the results speak for themselves. The weekly approach allows them to adapt more quickly to market conditions and capture premiums from Bitcoin's frequent price movements. This isn't a core holding for most portfolios. It's more of a satellite position for investors who want maximum income generation and are comfortable with higher volatility. The 32% yield is impressive, but it comes with the responsibility of understanding that weekly option strategies can be more complex and potentially more volatile than monthly approaches. Now, let's have an honest conversation about these ETFs. They're not magic money machines. They're sophisticated financial strategies that carry real risks alongside their impressive yields. These funds work by selling options against their underlying holdings, which generates income, but also caps upside potential during explosive market moves. Here's my recommended approach. Start small and diversify across all 5 ETFs rather than going all in on just one. I personally reinvest most of my distributions to compound the growth, but you could certainly use them as income if that's your goal. Remember, most of these distributions are taxed as ordinary income, not qualified dividends, so plan accordingly with your tax strategy. From a portfolio allocation perspective, these high-yield ETFs should represent maybe 10 to 20% of your total portfolio maximum. They're powerful tools, but they shouldn't be your entire strategy. The key is balance. Use them to enhance your income while maintaining exposure to traditional growth investments. Most importantly, past performance doesn't guarantee future results. These ETFs have performed well since inception, but market conditions change, and volatility can impact both the income generation and the underlying asset values. Stay informed, monitor your positions, and be prepared to adjust your strategy as needed. So there you have it. 5 high-yield ETFs that are actually growing your money while paying substantial dividends. Now I want to hear from you. Which of these 5 ETFs interests you most? Drop your pick in the comments below, and I'll personally respond to every comment with my thoughts on your choice and how it might fit into different portfolio strategies. If you found this analysis valuable, make sure to hit that subscribe button because I release detailed ETF breakdowns and portfolio updates every single week. And if this video saved you from falling into a yield trap or helped you discover a new income strategy, smash that like button to help other investors find this content. Remember, the best investment strategy is the one you understand and can stick with through various market conditions. These ETFs offer compelling opportunities, but they're just tools in your broader wealth-building journey. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.